please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good afternoon. Welcome to Halftime Report. It's 12 noon. We're halfway through the trading session and the mid-caps continue to reel under significant pressure. So while the benchmark indices have lost up to about a half a percentage point, it's the Midcap Index which is down close to about 1.5%. So continuing with that underperformance. Numbers coming in from Venky's where the profits have gone up by 22%. Revenues have gone up by nearly 20%. The stock is down close to about 3%, actually taking a big fall post the Q4 numbers. EBITDA has seen a rise by nearly 12%. So we'll try and dig in and get a sense of what could have disappointed the street so much. One could be margins. Margins have corrected by 100 basis points on a year-on-year basis to 13.5%. So that could explain a bit of the fall. But a sharp slide seen in Venky's post the numbers. Margins are down 100 bips.
Well, Reema, I think the numbers, yes, I mean, they may be a bit disappointing, but the stock has been a three-bagger in the last 1 year. In May 2017 itself, the stock was at around 1,100 rupees, so it's already at around 3,800 rupees. So irrespective of what the numbers are going to be, we could expect some kind of profit booking. I think that's exactly what's happened.
No room for disappointment.
Yeah, no room for disappointment. Interesting to see where the stock goes from here, but it's had a big run, currently moved to the low point of the day. Let's see whether or not this dip is spot or not. We'll talk more about that. First up, running you through. All right, then it's earnings season, so let's get chatting with the management of RPG Life Sciences. We saw a bit of an operational improvement. That's what stood out really. The revenue growth, though, is not as good as some part of the street was expecting, though margin improvement. That's trickled down to the profit. We have Mr. Ranganathan of RPG Life Sciences who joins us, the MD of the company. Hi, sir. Thanks so much for joining in. Well, in terms of a top line, we have seen a growth of around 12%. If you could help us out, sir, with a couple of details. The domestic formulation business, what was the contribution coming in from there for the fourth quarter as well as for the full year? And also, if you could give us a sense about how your new products were accepted.
I think, let me give you a quick overview about the company's performance. As an organization, we have achieved 344 crore for this year, which is almost 18% growth over the last year. And for the fourth quarter, we have done 86 crore, which is also again 18% higher than the last year. So overall, as a company, we are delivering 18% growth. And it is in line with last 3 years. Consistently, we have been delivering a high 18% mark. What is most important is the domestic market is the largest contributing business for us. It's contributing close to around 60% of our business, and remaining 35 to 40% comes out of international. In the domestic market, we launched a few new products which are doing well, like Darbapoetin, Rituximab that we launched at XMAP in Nephro division, and then main division Lomofan Plus is doing well, and also we introduced oncology like Trastuzumab. We launched it started picking up well. So overall, the new products have started kicking on well.
Right.
So as a company, we are going strong.
Mr. Ranganathan, sir, you know, we have your numbers as you're detailing it for us as well. Things have looked good. You know, you're saying that you've grown by around 18%. What about FY19? What kind of a growth number are you looking at there? And you were talking about your oncology unit. If you could give us a sense of what was the total sales for the full year, that's for FY18. And going ahead, what kind of a contribution can they give us, sir?
Okay, that is important. Oncology is a relatively new business for us. We were not doing well earlier. We were doing around 10 to 11 crore a year. But now we have introduced Nab-Paclitaxel as well as Trastuzumab. Started doing, these two products are doing around close to 2 crore a month. So as a company, we are looking at oncology as a long-term committed by having a better monoclonal antibody strategy. So we strengthen the portfolio. We are looking at down the line 3 to 4 years, it should give around anything 60 to 80 crore kind of a volume we are looking at it.
Oh,
okay.
In this year?
No, in 3 to 4 years. Okay, so oncology...
3 to 4 years.
3 to 4 years, yes, I got that. Mr. Ranganathan, afternoon, before I get to, individual numbers, the company was getting ready for the US FDA to audit your Ankleshwar unit in 2018. Could you give us an update on that?
We have done all the possible attempt to develop that plant is ready to go for auditing. Most likely end of this year or maybe early next year, it will go for auditing. We are preparing ourselves and we are ready almost, I can say that.
Okay.
End of this year or early next year, you expect the US FDA to audit your Ankleshwar unit?
Yes.
Okay.
All right. So, you know, you had mentioned the same last year as well. And the other factor that you told us was that we're looking to reach the United States of America. You were looking to reach that market as well. Any updates, sir, on that?
Yes, because once we get an approval from FDA, then normally we have to submit an ANDA. It takes 9 months to a year. So most likely by end of 19 or early 20 that we are planning to enter into the market.
Okay. Your margins have been doing quite well. In fact, you've hit double-digit margins for 2 consecutive quarters in a row. What's your guidance on margins for FY19? Holding in double digits above 10%?
Yes, that's what we are looking at it. We want to grow. Right now we are 11%, 11.5 it's coming now. So we want to make sure that we are delivering much better than what we are doing it.
Okay, so above 11% margins.
We are trying to improve the gross contribution. Yes.
Mr. Ranganathan, I remember you telling us that your international formulations business was growing at a faster clip than the domestic business. For the last year, if you could tell us what was the growth in the domestic formulations business and what was it in the international formulations business, and going ahead, how do you see that panning out?
Domestic market has grown by 11% for the quarter.
Okay.
For the year, it has grown by 17%.
Okay.
Overall, as a company, the main business is doing well. Nephrology is doing well. Oncology is doing well. The urology business we launched, we are looking for a better uptake in this year. So we are confident that overall the domestic business will do well. Internationally, the global generics, which is in Europe, all is doing well. Rest of the world market is not doing that great. So, but international, without rest of the world market, if we take it, we are growing at the rate of 40 to 50%. We have done around 53 crore last year.
Okay. All right, we'll leave it at that. Thank you so much, Mr. Ranganathan, and all the best for the coming quarters. So that's RPG Live. Looking at a better year coming in from FY19. Oncology is doing quite well for the company and getting ready to tap the US market as well, with the Ankleshwar unit likely to go for a US FDA audit by the end of this year or early next year.
Keep your eye out on the Nifty. In fact, you know, we are not really seeing any big bounce in today's trading session. The Nifty Bank is down close to around 50 points odd, but the Nifty on the whole will be down close to around 60 points, and every kind of bounce that we're seeing is really getting sold into. So keep an eye out on that front as well. A couple of stocks, though, that have been moving in the last few minutes. Well, if you pull up, you know, something like a Reliance Naval, that stock has moved lower. PC Jewellers has been all over the place. You know, that stock had bounced around 125 rupees odd. Now, in fact, it's again moved lower. It's moved to around 112 odd. But Jet Airways, Indiglobe, yes, there was some selling pressure there owing to their numbers. But Jet Airways, by the way, is down close to around 10% as we speak. So keep an eye out on that stock as well. But let's get straight to chatting with the next management. We have Responsive Industries. That's the stock on our radar after the company posted a mixed set of numbers, a bit of a decline that we're seeing on the top line. However, we did see margin improvement because the material cost, in fact, did see a bit of a downtick. We have Mr. Agarwal, the MD of the company, who joins us in the studio. Hi, Mr. Agarwal. Thanks so much for joining in. If you could tell us, why did we see such a big decline on the top line? Though profitability, that improved a tad bit. Is this the strategy you're looking at going ahead? And what kind of a revenue growth can we see for the coming fiscal?
So this is a deliberate strategy. Thank you, Nigel, first of all. This is a deliberate strategy from the point of Responsive Industries. We reduced the top line because we've discontinued our economical vinyl flooring, which used to service the low segment, the low Hutmans and things like that. And it used to be a large part of our revenue, but there was a shift in 17-18 to sort of go towards a high value segment. So go from the low margin to the high margin segments, and therefore it's been a deliberate shift in the strategy of the company. 17-18 reflects that shift, and 18-19 will sort of answer the next part of your question in terms of revenue growth. We are actually focused more on creating value for the company and being profitable at the EBITDA level. So the next year we expect to see, turnover to be more or less consistent, but really the impact will be at the EBITDA level because of the transition from the low margin to the high margin strategy.
Okay, so Rishabh, FY19 revenues flat, you would say, and what could be the extent of margin improvement?
The margin improvement we expect to see is straight from 10% to roughly 20% odd on the EBITDA level. So we expect to see a significant improvement in margins simply because...
so your FY18 margins are roughly 20-21%.
FY19.
No,
March
18,
19.
I'm saying are 20-21%. 19 would be how much?
So the EBITDA numbers, if you look at it, are close to about 10 to 11% on FY18. And FY19, we expect the EBITDA numbers to go up to 20 to 22%.
All right. So for the next year, we're looking at 1,200 crores and 240 crores in terms of an operating profit. You have to plug those numbers in. Fine. Okay. If you could help us out, so next year it's going to be more or less flattish. But do you have plans of setting up more capacities in terms of this profitability that you're looking at? Do you have the funds, and what's your balance sheet looking like?
So for the forward, we have enough capacities in place installed today. So we are able to grow very quickly over the next 3 years in terms of top line and profitability, maintaining about 20 to 25% EBITDA. And we expect the top line to grow at a CAGR of about 25% year in on year in after that. Right.
Rishabh, if you could tell us what is the current capacity utilization? Let's make it a little simple for our viewers. So the current capacity utilization next year, what is it likely to go into? And post that, how do you see that scaling up?
All right. So the capacity utilization today is close to about 30 to 35%. And we expect the scale up to be about 10 to 15 year in and year out. So we expect to hit about 80 to 90% capacity to utilization about 5 years from now. Okay. But that would see, it would see about 3 to 4, it would see a top line growth of about double from where we are today. And the bottom line growth would still track the 20-25% that we were talking about.
Your capacity utilization is at 30-35% because you've shut operations of the low value business?
Absolutely. Perfect. Right there.
Okay. Could you give us a sense of what the balance sheet of the company is looking like in terms of cash as well as debt, and any plans?
So the debt on the balance sheet is extremely low, zero to speak of. So the ECB payment, there are 2 quarters of ECB repayment left, which will be done with September. So after that, we've got zero long-term debt on our books, and we've got only about 150 to 160 crores of short-term borrowings on our balance sheet. So in terms of the debt, we are well serviced, and the cash flows of the business more than cover any debt liabilities that we have. In terms of the cash flow, we've always serviced most of our operations. So we are very comfortable as far as the cash flow and the debt profile of the company goes. And in fact, we're in a position of strength to sort of grow from there.
Okay, all right. So you're sounding confident. You're saying that revenues are going to double next 4-5 years, or your margins are going to increase. Operating leverage will play out from around 20-25%. So every year, what kind of a cash profit will you be generating?
So the cash profit we are looking at, next year is, close to profit before tax of close to about 100 odd crores is what we are looking at. There are 2 other implications which have happened as well. The interest, the interest expense of the company is going to come down considerably. ECP is already repaid. The short-term working capital is not that high. So we'll come down from about, last year was about 24 odd crores of interest expense. This year 17. Next year is going to be even less. And then you compound it with the fact that the depreciation expense of the company is going to be far less. Yeah. So your profit before tax, the numbers are just going to look significantly better going forward.
Now you're currently paying very small dividend. In the last few years, it's only been around 10 paise or your interim dividend, your final dividend. If this is going to be the scenario that, you're guiding all your viewers and all your investors, if there's going to be more cash in the books, what can your investors look forward to? How do you plan on utilizing this? Can you up the dividend? Can you do a buyback? What can you do for your shareholders?
So what we expect to do is that there has been, focusing towards this high margin item. Now, all these things are to come onto the books. We will take a call as far as the, the benefit of the shareholders is concerned. We'll take a call within the management, within the board, and decide how to sort of go forward with dividend recommendations and those kind of things.
Okay.
All right. Thank you very much, Rishabh, and congratulations on being appointed as the MD of the company. Look forward to speaking with you a lot more. So that's the word from Responsive Industries, targeting a significant improvement in their margins going ahead, as the company will solely focus on high-value products. Stock is down 5% today, but bear in mind it's seen a huge run-up in the last 2 months itself. Get into a break then. On the other side, we'll address the market technicals with Ashwini Gujral and Rajat Bose.